The bank collapsed. How did this happen? £11 million vanished. That number cuts the scene. $11,000 on the ledger. Ledgers burned in imagination. A London fog. The Bank of England dome watching. Overend, Gurney Co. was once called the banker's bank. It discounted bills. It moved cash overnight between firms. It settled the city. That was the fact. When it failed, the money markets froze. The consequence was immediate. Markets stalled. Other firms could not borrow. The human cost was instant. Clerks locked out of their offices. Deposit holders queuing in the rain. Families unsure if their wages would arrive. The firm began as a short-dated bill house. It handled merchant paper. It took tiny maturities and turned them into trusted liquidity. That was the origin. Because it played that role, a crisis there spread outward fast. Interbank credit flowed through its doors. When confidence flickered, the arteries clogged. Small provincial banks found their lines cut. Shopkeepers could not get advances. Lives depended on a single firm's reputation. Then the decision changed everything. The partners chased yield. They bought long railway securities. They held large blocks of long-dated bonds. They abandoned the short discounting model. That was the choice. Consequence, the balance sheet warped. Short liabilities met long assets. Maturity mismatch grew. Concentration risk climbed. Human impact. Depositors who thought their money was safe watched headlines and withdrew it. A clerk who had worked there for 20 years worried his family would go hungry. For a while, the gamble paid. Railway paper delivered handsome returns. The firm grew in size and in swagger. New deposits flowed in. That was momentum. Consequence, scale masked fragility. Other banks lent more against Overend's name. The city increased its exposure. Human impact. Celebrations in the partners' parlors. Tradesmen took on work for bigger offices. The Gurney name meant prosperity for many. Warnings appeared next. Rumors swirled in the coffeehouses. Some bills refused to roll. Counterparties hesitated. Concentration in railway paper showed on the books. That was fact. Consequence. Credit lines tightened. Overnight lending dried up. Interests crept up. Human impact. Small bankers called anxious clients. Families delayed marriages. Mills slowed production. Apprentices were sent home. The pressure increased. Withdrawals accelerated. Attempts to refinance failed. Borrowing costs exploded. Bank rate climbed toward 10%. That was escalation. Consequence, rolling became impossible. The firm faced a liquidity trap. The maturity gap was now a noose. Human impact. A shopkeeper who had financed stock on a Gurney advance found supplies unpaid. Employees watched the notice pinned to the door. On a Friday in May, the announcement came. Overend stopped payments. It suspended business. That was the turning point. Consequence, panic hit like a gale. The stock exchange convulsed. Runs spread to other firms. Human impact. Men ran down Lombard Street. Women clutching savings left tearful letters on counters. A clerk handed a small boy a coin and told him to go home. The collapse propagated through a tightly woven credit web. Wholesale liquidity evaporated. Some firms failed outright. Others teetered. That was systemic failure. Consequence. Trade slowed. Bankruptcies multiplied. Businesses closed their shutters. Human impact. Families lost roofs. Workers lost wages. Communities that depended on credit for monthly payrolls faced destitution. At the center stood a decision about asset type. Long, underperforming railway securities could not be converted into cash on demand. The Bank of England was asked to intervene. The bank refused to support those long assets. That was a critical policy choice. Consequence, without central support, the firm had no backstop. Market confidence could not be restored by a public lender. Creditors fled. Human impact. Men who had trusted the Bank of England's presence felt abandoned. A retired depositor who had chosen the banker's bank for safety found his savings trapped. Rescue efforts followed. Parliament held inquiries. Private syndicates tried to stitch deals. That was the immediate response. Consequence: some credit lines reopened. But the damage was done. Regulatory debates began. Human impact. The ruined searched for work. Families rearranged lives to survive the shock. The inquiry traced causes. It found concentration. It found maturity mismatch. It found a failure to revert to the old safe business. That was forensic truth. Consequence: the city rewrote some rules of engagement. Banks watched exposures more closely. The idea of a single trusted discount house changed. Human impact. New bank clerks were hired with stricter rules. But many who lost everything could not be restored. Long-term consequences unfolded. Public trust in short-term credit markets never fully recovered overnight. The architecture of Victorian finance was exposed as fragile. That was the legacy. Consequence: lenders diversified. New practices spread. The role of the Bank of England in crises became a live debate. Human impact. Generations learned caution. Families educated their children away from banking risk. The story ends with a lesson written in ledger ink. Size gave Overend power. Centrality gave it influence. Concentration and bad timing turned power into peril. When markets demanded cash, long railway paper could not answer. The failure was not a single accident. It was the inevitable result of choices. Choices to chase returns. Choices to lock liquidity into long assets. Choices that the central bank would not underwrite. People lost jobs. Homes were lost. Trust was eroded. That was the human cost. The forensic takeaway is simple. When a firm becomes a plumbing hub and then fills itself with illiquid, underperforming assets, the plumbing will burst. Overend's collapse shows the same rule that topples dynasties. When size and centrality meet concentration and mismatched timing, failure is not if, but when.